Hello, everyone, and welcome back to our channel where business and law meet. Today, we dive into the world of global tax planning, specifically how multinational giants like Apple, Google, and Nike leverage IP assets to generate billions in income while minimizing their tax footprint. Our video will be divided into 5 sections that build upon each other to form a comprehensive understanding of this complex, yet profitable strategy. So let's get started. Before we dive into our first example, let me ask you this. What if I told you that some of the world's biggest companies regularly pay themselves billions of dollars in royalties while dodging hefty corporate taxes? It might sound like a tax haven scheme, but it's not. It's sophisticated global tax planning in action. Companies like Apple, Google, and Nike route their intellectual property rights through subsidiaries in low-tax jurisdictions, resulting in massive royalty income that's subject to much lighter tax rates than traditional corporate income. So, what's the secret behind this global blueprint, and how can your business benefit from similar strategies? Stay tuned as we explore the nitty-gritty of IP licensing and royalty routing. Let's start by looking at Apple Inc. For instance, Apple has a wholly owned subsidiary called Apple Operations International, which holds a perpetual exclusive worldwide license to all of Apple's intangible assets, including trademarks, trade secrets, and patents. This means that Apple's operating businesses around the world actually pay royalties to Apple Operations International for using these assets in their day-to-day operations. In fact, Apple Operations International was responsible for approximately 5% of Apple's total revenue last year. But why does Apple route its IP rights through an offshore subsidiary? Well, it's a smart tax strategy. Apple Operations International is based in a low-tax jurisdiction, and by channeling royalty payments through this entity, Apple can enjoy significant tax savings. In fact, Apple paid over $700 million in royalties to Apple Operations International in the last fiscal year alone. Imagine having a dedicated team of tax experts, crafting a strategy that lets you pay yourself millions while keeping more money in your pockets. Now let's talk about something incredible. Did you know that a company called Apple Operations International, raking in over $700 million in royalty payments every year? That's no small feat. What's even more mind-blowing is that Apple Operations International is a subsidiary of the tech giant Apple Inc. and plays a pivotal role in Apple's global tax strategy. You see, Apple Operations International is domiciled in a low-tax jurisdiction and holds the intellectual property rights to all of Apple's intangible assets. This means that Apple's various subsidiaries around the globe need to pay royalties to Apple Operations International whenever they want to use those assets. Now, here's the masterstroke. Apple has structured things so that Apple Operations International sits in a tax haven, while most of the actual economic activity happens elsewhere. This way, Apple can enjoy substantial tax savings and boost its bottom line without compromising on quality. It's a brilliant strategy and one that has helped Apple become the cash-rich company it is today. All right, let's dive into our second example. Alphabet, Google's parent company, has been a trailblazer in this space. Until recently, Google operated a structure dubbed the Double Irish with a Dutch sandwich. Let's break that down. The core of this structure was a series of intercompany agreements. Google Ireland Holdings, located in Dublin, received royalty payments from Google's various operating companies around the world. These operating companies were responsible for generating ad revenue from their respective markets. Once generated, the profits were shipped back to Google Ireland Holdings in the form of royalty payments for the use of Google's intangible assets, such as patents and trademarks. This royalty income earned by Google Ireland Holdings was subject to Ireland's 12.5% corporate tax rate, significantly lower than the 35% rate in the United States. However, the story doesn't end there. The royalty payments made by Google Ireland Holdings didn't stop in Ireland. They were channeled further to another entity, Google Netherlands Holdings, which acted as a holding company for Google's European operations. From there, the royalties were routed to Google Overseas Holding Limited in Bermuda, a tax haven known for its zero corporate tax rate. This intricate structure allowed Google to reduce its overall tax bill substantially. By strategically moving royalty payments across jurisdictions, they ensured that the profits were subject to the lowest effective tax rate possible. However, due to mounting pressure from the European Union and the United States, Ireland ultimately closed some of the loopholes in this structure, leading to Google's decision to shift its European headquarters from Dublin to London. Despite the changes, the essence of the strategy remains, allowing Google to optimize its global tax position. Okay? Let us talk about another real-world example of a company that uses the Netherlands as its IP hub for royalty routing: Netflix. One of the reasons Netflix chose the Netherlands is because of its extensive treaty network. This means that Netflix can benefit from reduced withholding taxes on royalty payments when sending funds from the Netherlands to its other international offices. Additionally, the Netherlands has tax agreements with several countries, including the United States, which allows for the deferral of taxes on certain types of income, making it easier for Netflix to move money between the two countries without incurring double taxation. Furthermore, the Netherlands offers a well-developed IP legal framework. This makes it easier for Netflix to protect its valuable IP assets and ensures that its rights to those assets are respected. Protecting IP is crucial for any company that relies heavily on intangible assets such as software, trademarks, and copyrights. And the Netherlands provides a stable and reliable environment for safeguarding these assets. All right, now let's look at another aspect of this strategy: hybrid mismatches. Starbucks found itself under the scrutiny of the UK tax authorities when it was revealed that the company had been paying royalties to a Dutch entity since 2003. This revelation came as part of the Panama Papers investigation, which exposed a series of offshore tax haven schemes used by wealthy individuals and corporations to evade taxes. Starbucks' royalty payments to its Dutch subsidiary resulted in a significant reduction of its taxable profits in the UK, raising concerns about the company's tax practices. The UK SHM Revenue and Customs investigated Starbucks' tax affairs, and ultimately the company agreed to pay £20 million in back taxes and interest for the years 2009 to 2012. However, it's important to note that while the payment might seem substantial, it was still less than the £80 million that HMRC originally claimed Starbucks owed. This payment reflected the attention given to Starbucks' royalty payments to its Dutch entity and the impact they had on the company's tax liabilities in the UK. The case study highlights the potential risks and challenges associated with engaging in cross-border royalty payments and sheds light on the importance of complying with tax regulations to avoid scrutiny from tax authorities. Now let's dig deeper into the third section: hybrid mismatches and OECD countermeasures. A hybrid mismatch occurs when two tax authorities treat the same payment differently. For example, the UK may allow the royalty payment to be deducted as an expense, while the Netherlands may not. This creates a situation where the taxpayer effectively benefits from a double deduction, reducing their overall tax burden. The OECD's BEPS project aimed to address this issue by developing measures to neutralize the tax advantages arising from hybrid mismatches. BEP's action specifically focused on countering the use of hybrid entities to avoid taxation. Under this action, countries were encouraged to modify their domestic laws and tax treaties to prevent double deductions and other abusive tax practices involving hybrid entities. To counter hybrid mismatches, the OECD introduced the concept of a principal purpose test, which requires countries to ensure that hybrid mismatch arrangements do not serve a main purpose of obtaining a tax benefit. Countries have incorporated these measures into their domestic laws and tax treaties to prevent the use of hybrid mismatches for tax avoidance purposes. For example, the UK and the Netherlands have implemented rules to prevent double deductions arising from hybrid mismatches. These measures include withholding tax exemptions and special allocation rules. By adopting these measures, Countries aim to level the playing field and ensure that all taxpayers are treated fairly, regardless of their choice of structure. The OECD's BEPS project and the introduction of measures to counteract hybrid mismatches have significant implications. 4. Multinational corporations. By understanding these developments, companies can adapt their structures and ensure compliance with international tax standards. Staying informed about changes in tax regulations and adapting accordingly is crucial for mitigating risks and optimizing tax strategies. Let's take a closer look at preferential regimes offered by different countries. Ireland is known for its attractive tax regime for IP holders. Its Knowledge Development Box provides a reduced tax rate of 6.25% on qualifying IP income, making it appealing for companies seeking to benefit from lower taxes on their IP assets. The Netherlands also offers an Innovation Box regime that provides a reduced tax rate for income from patents and other qualifying IP. This incentive aims to encourage companies to develop and commercialize IP within the Netherlands. Similarly, the UAE has introduced a 9% corporate tax rate, but with carve-outs for qualifying IP income. This move aims to position the UAE as a hub for IP and innovation. Other countries like Luxembourg and Switzerland offer IP incentives in select cantons or regions to attract companies looking to benefit from lower taxes on IP income. These preferential regimes are designed to promote innovation and economic growth by providing tax incentives for companies engaged in research and development activities. By offering lower tax rates on IP income, countries aim to create a favorable environment for companies to develop, protect, and commercialize their IP assets. These measures can help companies reduce their overall tax burden and increase their profitability, which can in turn fuel innovation and economic growth. However, it's important to note that these regimes often come with substance requirements to prevent companies from exploiting the incentives without making a genuine commitment to IP development within the jurisdiction. Now let us look at a practical example of how a company like Nike leverages the global IP hub model. Nike Inc. transfers its trademarks to a Dutch entity, Nike BV, which then receives royalty payments from Nike subsidiaries around the world. In exchange, Nike BV pays royalties to Nike International Sorel, a holding company based in Luxembourg. Now let's look at the global IP hub model. R&D is performed in the United States, where patents are granted. The patents are then transferred to an Irish subsidiary, which serves as the IP hub. This subsidiary licenses the patents to local entities in various countries, collecting royalty payments in the process. The chosen countries typically have low corporate tax rates or tax holidays, making them attractive for establishing local entities. Ireland serves as the primary IP hub, but the Netherlands also functions as a backup hub for certain product categories. Subsidiaries in different countries pay royalties to the Irish IP hub, which distributes them to the Dutch IP hub based on the proportion of sales in each product category. If the Irish subsidiary doesn't hold the rights to a particular product category, the subsidiary in the respective country pays royalties directly to the Dutch IP hub. Ultimately, the Dutch IP hub collects all royalties and redistributes them to the Luxembourg holding company, which then distributes them to the ultimate beneficial owners. That's it for today's video. We hope you enjoyed this deep dive into the world of global tax planning and the role of intellectual property in this strategy. If you found this video informative, don't forget to subscribe to our channel for more insightful content. We would love to hear your thoughts in the comments below. Thank you for watching, and we'll see you in the next one.